All right, well, good afternoon, everybody, and welcome to the May 11th edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula. Say good afternoon, Ken.
Good afternoon, everyone. Glad to be with you.
And we are also joined, at least for part of the session, by Kim, also known as the Roundtable Cha-Ching Damsel. She's a guest damsel at many of our roundtables and has quite a track record when it comes to picking stocks, including some unusual stocks from time to time. Good afternoon, Kim.
Good afternoon, guys. Hope you're all having a great day.
When I say unusual, I mean unusual and profitable most of the time. So that's good stuff. All right, we do have a bunch of stuff to get into today. I do want to assure everyone in the audience that the Chinese rocket fragments on the screen, no animals were injured in the landing of that rocket, so we can display it proudly. Did come with a fortune, apparently. Quite an event, as we were saying in the green room just now. I mean, the prediction that it will land somewhere between the longitude of New York and someplace in Chile in South America, that's like 80% of the globe, and that's not much of a precise prediction, but oh well. We try to do better with our stocks. We are going to be sharing with you moments from the conference that we'll be running over the next 3 days, our Successful Investing 3 COVID cancellation conference number 3, hopefully our last, at least, COVID cancellation conference. Would you second that, Ken?
I hope so, Mark. I hope that the things continue on the path they're continuing on, and I hope we begin to get some vaccine into the places in the world that are really suffering at the moment.
Yeah, because I'm ready for some face-to-face stuff. Dallas is coming up in a few months, and let's hope that all things spin in the appropriate directions. We'll probably continue to do successful investing conferences, but some of them will probably attempt to be face-to-face or some type of a hybrid, that kind of stuff. One last comment on Buffett. We were kind of tough on Mr. Buffett last weekend in the Berkshire Hathaway annual meeting. I still don't think it was their finest hour, but they've been doing it for a long time, and they're permitted a speed bump from time to time. I will note that I watched a number of pundits share very similar thoughts, including Josh Brown and others. So we weren't alone in our thinking on that one. But we are going to share that Warren busts a move here in today's session, and that happens to be a picture of Mr. Buffett pointing to Ted Williams. You probably remember Ted Williams, Ken, right?
Yeah, I was an adult when Williams was a baby. Sure, Mark.
When they were still writing American Pie.
No, I do remember Ted Williams, however, and he was actually a player that I can remember in active play for a few years.
Is that, one of these days we probably should get Cy to, Cy does a lot with baseball and investing, and I know he's done a little bit of stuff, but maybe do a little bit of another session on the science of hitting. That's what Warren is talking about in that picture. You don't have to swing at every single pitch that comes your way, and that's been Buffett's philosophy going way back. The other reason that colored sunset is on the screen is, and we've chosen that for our Successful Investing 3 background, that actually is an Omaha sky. So it's a tribute to Buffett and Berkshire Hathaway in their annual meeting that happened fairly recently. All right, so let's go ahead and get underway. Get the official paperwork out of the way. No investment recommendation whatsoever is intended. This is an educational demonstration. Everything that we do here is an illustration or some form of demonstration based on the lessons learned and delivered by the Modern Investment Club movement, as championed by the National Association of Investors, Better Investing, and as interpreted and continued to be promulgated by Manifest Investing. All opinions that will be expressed by us, please consider them to be opinions, and please do your own homework before making any investment decision. We do try to remember when we hold stocks or know someone who does, and disclose that. We hold a monthly roundtable webcast that we have a lot of fun with, and if you'd like to be added to that reminder list, email list, please send an email to ncavula1@comcast.net. It's one of our principal programs that we've been doing for 11 years, and that's been something else. Pretty solid returns on the stocks that have been explored and shared as potentially investable ideas amongst the community, many times from the community. If you'd like copies of these slides, or if you have questions or suggestions for future topics at these Tuesday 2 p.m. sessions, please send an email to me, Mark R. at manifestinvesting.com, and we will put it in the queue. So with that, here is the queue as it stands today, and some of the stuff that we're going to go into. We are going to spend a few minutes giving you some sampler platters from the next few days. I do want to spend a moment with the Hulbert efficacy indicator, talk about Buffett's move on the dance floor, and I wanted to reminisce a little bit over those RSI-driven shopping moments a little over a year ago. Kim remembers them as the hot dog moment. When I went to make a hot dog and missed a buying opportunity in a span of just a few minutes, and we'll go back and actually relive that moment. But basically, we just want to share some stuff and kick around some ideas and some of the stuff that we'll be covering over the next few days. Anything jump out at you, Ken or Kim?
No, let's get this train moving here.
No, I kind of think that we could have had a RSI moment yesterday.
We may be having one today. I didn't check before we actually started. The Dow was down 600 a few minutes ago. So somebody might want to check that and let the audience know what the score of the game is as we're doing this. And after I added this slide, I did add a future topic, inflation jitters. And that's a topic that's right down Ken's wheelhouse. And that's something I think we probably should cover. Why would inflation bother us? And what should we think about it for a future session, Ken? If that sounds good to you.
Yeah, I can dust off those classes I used to run on inflation too, Mark. It seems that I ran those classes for 2 or 3 years and inflation completely collapsed. So
Well, maybe you are the antidote to the problem.
that could be it. That could be it.
Talk about it. It's kind of like an effigy thing. All right, let's start with something fairly heavy, but it's not as heavy as it might look. Everybody take a deep breath here. What you're basically looking at here is a slide that the moral of the story, or the whole story behind this, is that stock selection guides work. Why do I say that? What you're actually looking at is what Value Line refers to as the median appreciation projection. That's the red bars going all the way back to 1999, and these are quarterly snapshots of what the average, or as it says, median appreciation projection is. So when you look at the red bars, you're looking at what Value Line was predicting back at these points in time, all the way up to the current day prediction. Now the green dots are what actually happened. So you're looking at literally, what was the prediction? What actually happened 4 years later. So the green entries on this chart are actually, there's a 4-year, we call that an offset on a graph, Ken, is that correct?
Basically, enough, yeah.
Yep. So basically you're looking at, the bar is the prediction, the green dots will be what actually happened. So again, with a few exceptions, there's obviously an exception down at the bottom of the chart here, and there's another one fairly recently. I would argue that those two are tracking each other pretty well. And the reason I say that it's basically one measure of proof that stock selection guides work is because I believe that Value Line is basically a stock selection guide. When you look at those company report pages, they basically do everything we do on a stock selection guide or one of our manifest investing stock studies, only they base everything on cash flow and price to cash flow. So it's a very similar technique, looking at very similar things. And it's just kind of neat to look at how those two track pretty well on top of each other. Again, an exception being what happened back in 2004. Obviously we had that tough moment in 2008, which is basically what caused that. And then the situation a year ago is what caused this. kind of an unusual moment in the stock market. So hopefully that gives you some idea that this stuff is kind of interesting. We're in the middle of a very disruptive period, one of those chasm type periods. But Mark Hulbert loves this chart. It's actually been in the Wall Street Journal a couple of times. You can go to that link down at the bottom and go back to the most recent appearance on Market Watch and the Wall Street Journal. I think Mark Hulbert and I have a discussion about this about every year or so, and he finds it fascinating. And the value line median appreciation projection is something that he follows fairly closely, and I would argue that it's been fairly reliable. In fact, that most recent appearance actually came back. Let me see if I can get my Madden pen going here. Back in this time frame here, the last time it appeared in the Wall Street Journal, I probably should have picked a different color. Let me pick a different color. We'll do yellow. Yeah, back in this time frame, right around here, it was part of a Wall Street Journal article that talked about an expectation for mid-range single-digit forecasts. A little bit less than usual. The market was a little bit overpriced according to many of our stock selection guides. It was hard to find a stock in the buy zone back then. And I have to tell you, after the article was published, I got a number of, and I'm using air quotes now, Ken, constructive comments, questioning my sanity and kind of abusing a little bit. Many emails and that kind of thing. And I guess I would argue that these dots which basically filled in right in that range are kind of a validation that they did actually come in that single digit mid-range for quite some time. So some good stuff. Dan Seaver's a professor at some Eastern university, and he keeps track of the actual statistics also.
Mark, I don't know if you've noticed it, but I've noticed over the last time period, maybe the last decade, the last 15 years, I've noticed that the general population seems to be demanding greater and greater accuracy out of almost anything that is measured. This whole argument about the vaccine hinges in my mind about people expecting that if you're going to have a vaccine, it's going to be 100% effective and it's never going to have an outlier. And the same thing, I think, is true of the stock market, that people read these numbers that are coming from the analyst community and they expect those numbers, even though you and I know they have a tolerance attached to them, but they expect these numbers to be right smack on top of whatever it's going to be, even if you're making a 3-year or a 5-year call. I think it's amazing that the numbers track as well as they do for as long as the call is in the future that the group is trying to make. So I'd come down the same place you did, that SSGs do tend to work. They're not perfect, and they're certainly not predictors to the 0.1% about what's going to happen. But they do give you a really good feel for where your stock has the probability of being in the next 3 to 5 years. I think that's as good as you can do.
Yeah.
When you're trying to make predictions that far out. And there's always something that'll be I think the current favorite term is there's always a black swan waiting to cross the data, whatever your data you're using. But for the most part, if things go normally, then I think the SSG becomes a very useful tool. And as you said, Value Line is doing SSGs with a slightly different twist attached to them. So we're sitting in the same ballpark.
Yep, and I do think that moment last March that is shown there by that spiky peak on the right-hand side, that'll prove to be a back up the truck moment. We'll talk about that at the close of the session today. All right, quick look at the Groundhog. We don't want to spend a lot of time on this because I promised we wouldn't do it every week, but there's your quick list. Again, the familiar names are always bring a smile to our face. We have not had a good week. We went from a 7% average return back down to 1. About 50 people beating the market at this time. Kathy Wood had an even worse week than we did. full disclosure, I did buy some of her innovation fund this morning. Just thinking that she's been really punished with some of the companies that are in there. It's a long-term investment. Tiny bit speculative with some of the stuff that she invests in, but I'm betting on Kathy Wood to do better than that over the long term. Some pretty good stuff top to bottom, but I do want to point out that Buffett has busted up into the top 3 with a pretty solid move at Berkshire Hathaway. Some of that's a flight to safety, I'm sure, but Warren has moved into the top of the list. Ken is still on the list at number 26, along with a number of his clubs. So go ahead and bask, Ken.
It looks like David Einhorn is playing Wile E. Coyote here. It looks like he just got to the edge of the cliff and took a step, going from 3, 4, 5 down to 17. That's a big drop in a very short amount of time.
Probably means he covered his short on Tesla and bought some and went long, and it went down instead of up. So I don't know. I'm just thinking out loud. Yeah, David took a dive from 3rd to 17th. And I'm probably hovering just off the bottom of that list. So when I get backed up into the top 40, the list will be back for sure.
Okay.
All right, here.
Well, I can tell you, I'm still not on the list.
You're not too far off of it, though.
That's okay. I don't want to be on the list until the last month or 2 before the end.
Yep, it's a marathon, not a sprint. People keep sending me notes along those lines. Okay, here's Berkshire Hathaway over the years. Just a moment to, again, celebrate the magnificence of Berkshire Hathaway and the investing excellence that we've seen over the years. Going back to the start of my involvement with the Chicago chapter for NEIC back in the early 1990s, and you see a pretty good record there from left to right. It's not always up. It's been pretty good here, though, over the last year or so. You can see that coming out of the nasty moment, things are going pretty well. And I also find it kind of intriguing that they're picking up an awful lot of activity volume-wise there. But one of the things I like to point out is an article which is in our forum. It's in our Getting Started forum at Manifest. It's an article from Fortune magazine back in April 1985, which followed an article from, I believe, 1983, that basically talked about how what Warren Buffett and his friends were doing was academically impossible. And they're just academically wrong because, they were wrong in 1983. They were wrong about it in 1995. People are always trying to shovel dirt on these guys and say their methodology doesn't work anymore. As they've gotten bigger and bigger, they continue to do pretty well. The guy on the left is Bill Ruin from Sequoia. He passed away a few years ago, I believe around 2005. The guy on the right is Walter Schloss. If you're not familiar with Walter Schloss, I would recommend you take a look at some of the stuff that he's done over the years. And that's Charlie in the middle there. And Charlie looks about the same as he did last week in Los Angeles. But again, I would encourage you. I would say that in addition to the modern investment club stuff that I've been involved with since the early 1990s, this article and the notion that you can find companies on sale and buy them and own them for as long as it makes sense to do so. This was a very influential piece of literature for me back in that time frame as I was trying to figure out what to do with my retirement fund. And I just tipped my hat in their general direction. And I just love the thought, here, hold our beer, watch us while we just go and do this. Your thoughts, Ken?
Well, I'm just looking, and I was investing in 1995. I'm just lamenting the fact that I could have just taken $22,000, $23,000 and turned it into $439,000 pretty easily by buying and holding. That's the wonder of compounding, but a 12% return is nothing to be sneezed at. And I know that that's not dramatic enough for a lot of modern investors that are used to seeing 40, 50, 60,000% returns and that are looking for returns like that. But I think I could probably live pretty comfortably on something that did 12% over the last what, 35, 36 years,
Yeah,
25, 26 years, I
it
guess.
definitely adds up. And Kim and I have a friend, he's a friend of many of you too, that back in that time frame actually bought Berkshire Hathaway kind of by accident. And it would have been back somewhere around here. And then he went back, he was going to sell it, and he ended up buying a second batch. So I believe he's pretty happy about that at this point.
Yeah.
Fair statement, Kim?
I said, yeah.
Yeah. All right.
That says it all.
Here's a quick one. We talked last week. I want to thank all of you for the notes that you sent to me. Nick, you know who you are. Excellent observations. I want to kind of string them all together and put something together, but we actually introduced the upside downside ratio greater than 3 as a potential screening tool and something that we might calculate for companies. Again, we're putting it through its paces, but the list that you see here is the companies with excellent or good quality ranking. So anything above, I actually went down to 60, but nothing from 60 to 80 made the top of this list. So these are all excellent companies, and they all have an upside downside ratio greater than 3. And by the way, I don't know how many companies are on this page, but those are all of them. Out of the 2,500 companies that we follow, you're looking at the ones that meet those two criteria: quality ranking greater than 80. In other words, excellent companies with an upside downside ratio greater than 3. Now, Ken, I know your eyes are drifting up to the right-hand side in those huge upside downside ratios, so I'll let you pontificate about what that means.
Well, I don't want to pontificate, but it just is something that we're going to have to work on a little tiny bit with this particular algorithm for calculating upside downside from the database. That just means that we've picked a low price for our choice that's probably too close to the price that it's trading at right now. The top 1, 2, 3, 4, maybe the top 5, maybe even the top 6 have a low price that's very close to the current trading price, and there's probably not much difference at all in those 6 upside downsides, because once you approach the actual price, once the trading price approaches the low price very closely, then that number just takes off like a rocket and moves, you know, for a penny, it maybe moves another 3 or 4 or 5 points. It's called an asymptote, and nothing you can do about the arithmetic. It is what it is. So.
Yep. So good stuff. So yeah, those are trading near their 52-week lows. Again, just a reminder, we talked about Regeneron last week. Here's a quick look at Mercury Systems and what it would look like. And I do think, Ken, we want to come back and maybe spend a little bit of time talking about sell above and buy belows. Don't need to do it right now, but I actually injected the pars at those 2 levels. There might be a topic in that all by itself, but again, it's exactly what you think it is, because it's being done in the confines of our database. We're using the 5-year forecast, which is again going to be an output of the same stuff that goes into a stock selection guide. It does not include any margin for what you might think of as a Bollinger margin above a future price. In other words, there's no plus or minus on the top. That's the median forecast, if you want to think of it that way. So that makes it slightly different. There's no cushion up here, no cushion down here either. We're using the 52-week low. So that is the only subtle difference, but the beauty of it is every single one is done the same. Go ahead, Ken.
And as long as we remind ourselves that when we're doing this same thing on an SSG, we're making a whole slew of judgments to come up with this bar graph. I mean, we make 2 judgments to come up with the high price, 2 judgments to come up with the low price, another judgment to decide which low price we're going to use. And then on top of that, we've moved the methodology a little bit. That middle bar range used to be a little bit different than it is right now. Instead of a quarter, 2 quarters, or a half and a quarter, it used to be a third, a third, a third. and that changed things a little bit as well. Whether you want to say that it made it more conservative or less conservative is a debate that rages in certain portions of the country. But the whole bar graph looks so simple, so elegant, but it's based on a whole slew of judgment calls.
Absolutely. So we will probably be digging into that in a little bit more detail. I know that people have been asking me for a few years, not very many, by the way, because most of us are more familiar with using the projected returns, the return forecasts for making the decisions. But some people have actually confessed that they would find an opinion on the buy below and the sell below prices to be meaningful, at least another piece of information. So we're kicking that around a bit. All right, let's go ahead and move on, Ken. We'll probably come back to that. I'll let you kind of talk a little bit about what the next few days hold. We've got some.
Well, Kim, we've added another damsel to our panel on Friday night. That lady that is unfamiliar to a lot of you in the audience, her name is Charlene Hansen. Charlene is a director on the Mid-Michigan chapter, and she's president of one of our model clubs. We have a lot of model clubs in our big geography, and she's president of one of the more successful model clubs up north of Traverse City. They have about 14, 15, 16 members, all of them mixed up, male, female. So that didn't come out right. That's not what I meant, folks. There's some men in the club, and there's some women in the club. But
We're all
Charlene,
mixed up, Ken.
Charlene has proved herself to be a pretty astute stock picker, and we're glad to welcome her to the panel. She's taking the place of Herb Lemkel, who's going to be traveling through the south at that point from his winter base in Florida back up to his summer base in Traverse City, and he'll be somewhere in the south. They're taking 5 days to make the trip from the Florida home to the Traverse City brand new condominium, he tells me. So we'll welcome Charlene, and she has a couple pretty nice stocks to talk about. Most of you recognize Kim. The second person there is Pat Donnelly from Pittsburgh, and Pat certainly is an astute stock picker. Pat tends to either do really, really well or really, really badly. There's not too much middle ground in Pat's picks. Would you say that's true, Mark?
Yeah, he's had some real zooms over the last few years, but boy, wait till you see the results here in a minute when Ken shares them with you.
Yep. And then that's me kind of in the middle next to Cy Lynch, who's giving us his over-the-shoulder look right there. Hugh McManus standing in front of the blue Pacific Ocean, Mark Robertson, and that's Matt Spielman, another one of our new panelists. And Matt's from the Michigan area, and then he went to Ireland, and now he's living full-time down in Houston. I think he's joined the Houston Model Club and might be on board for becoming a board member with the Houston chapter as well. So it's a great panel. We would like to have some picks as good as the picks that we've done in the last two conferences. We'll show you those in just a second, but here's a breakdown of the classes that will begin tomorrow. Tomorrow afternoon, we'll do small company screens and ideas. That'll be Mark and I talking about our favorite topic, small companies, why they're important, where you can find them, where you can get ideas, and we'll be doing some real-time looking for candidates. We know that right now the market is at a place where it's a little bit more difficult to find any candidate at all for investment purposes. So we're going to try to direct you in a couple places, including maybe looking at a few places that we don't normally look. I think that interesting stocks right now include some of the regional banks. And if you don't have a regional bank in your club's portfolio or in your personal portfolio, maybe that's a great trigger to come up with a really high quality one and find a way to move it into your portfolio. You will have missed the return of the bank, but it's only right now gotten back to where it has normally been. If interest rates go up at all in the next couple of years, and from my point of view, they have to, then banks will be very, very profitable, and banks do a pretty good job of turning that money into shareholder wealth.
You know,
On Thursday, go on, Mark. Go on.
you know, I've done a lot of thinking about your request, and I really don't think you should bring Dogecoin to the small company presentation.
No worries, Mark. Okay, no worries there.
All right, carry on.
On Thursday, we're going to be talking about from theme to target, and we know so many of you struggle. You have an idea, and then you don't know where to go with that idea to find companies that might make you some money. And we're going to talk about some of these big ideas, and then how you can pare them down into something manageable and focus them on a couple, 3 or 4 companies that might be profitable, and stay with that concept, whatever it happens to be. We'll be talking about portfolio management in the second class on Thursday. Some of the topics will be familiar to those of you in this audience, but a lot of the general topics that we're talking about will be things that are applicable to almost any portfolio at any time, and we'll be pressing home some ideas that we think can really add a little bit more to your return than you would normally have if you just buy and stored stocks in a portfolio for the next 50 years. Sai's going to talk on Friday about stacking the deck in your favor. Sai's been doing the SSG as long as anybody in our group has been doing SSGs, and he's gained a lot of tips and tricks and interpretations that I think you'll find fascinating and helpful as you try to pull SSGs together. And then, of course, the most popular class in the group is our panel, Let's Talk Stock, coming Friday afternoon. We hope that all of you sign up for that one, even if you don't have time to go to some of the others. You can sign up on Manifest Investing, upper right-hand corner where it says events. All the URLs are there for you to sign up. You can sign up on the Mid-Michigan page on Better Investing, and that page has URLs. But if you can't find any of that, send me an email, and I'll send you the URLs right back where you can sign up immediately for 1 or 3 or all 5 of the classes that you want. Here's our panel selections from last May. That's just about a year ago. Doing pretty well. I mean, you can't beat an 86% total return and a 31%, 32% almost relative return for a random group of stocks. And this is certainly a random group. There's no theme or no set of rules that have come together to pick these different stocks. You see that Pat Donnelly has the top pick, and that stock is certainly doing really well, but I wouldn't send Sai away for picking bad stocks. I mean, to come in number 2 and number 3 with stocks that we've heard of before, with stocks that we're familiar with, is certainly something that I just think is fantastically supportive of what we do. Mark slides in there, then Pat again. Kim and I haven't done it quite as well in this set of picks as we might have, but sometimes we blow the lid off the place. So let's go back to the first conference. That was only 6 months ago, right, Mark? In November. And there, my 2 stocks have moved up into the top up there now. Kim has one in the top 5, and we still have Pat sitting at the top. So Pat's running really hot, but Pat's also running kind of cold down in the middle down there. You might not have heard of a lot of these names. This is only about 6 months, maybe 6.5 months of return right now. So some of these still might be very interesting. The only one that probably you want to kind of walk away from right now is Emergent Biosolutions. It's kind of caught up in all the problems that it had with Johnson & Johnson and with making that batch of vaccine. But I just heard a very positive report today on Teladoc, and I'm not familiar with a couple of others near the bottom of this list. Hugh made an extremely positive presentation on Gilead at the last roundtable. That if you go to our YouTube channel, you can listen to Hugh McManus' Gilead presentation. It's has a positive total return right now, but it has a negative relative return. In other words, it's doing better than zero, but it's not quite beating the same thing if you would have put it in a market index. Altogether, no, a nice set of choices to take a real look at. And we'll come up with another 16 stocks this coming Friday in the afternoon. And again, please register. We have a really, really nice registration, but we have room for a lot more folks yet. So if you know anybody, it's free. You don't have to be a member of anything to join the group. So come and listen to some entertaining education, and also maybe get some really great ideas about what you might want to study for future investment.
All right. So
Mark, any thoughts?
are you happy now, Ken? I mean, this
I am happy, yes, that I'm looking at a chart where my name's not at the bottom. That's really good.
Well, this particular spreadsheet is really hard to find for some reason for me. When I dig into the computer, and it just, for some reason, it doesn't want to come up on a regular basis. And I'm hoping.
Well, that's exactly, the first time you showed the other sheet, I was in the last place and third from the last. So turnaround is fair play here.
And now you're telling me that I have a beautiful emergent biosolutions presentation for Friday. I guess I have to rework it now.
I think you should. Yeah.
Well, it might fall into that loathing and sullied index that Hugh likes to talk about. He went for BP a couple years ago. All right. One of the things that we will be talking about a lot when it comes to the small company presentation is just a reinforcement of why you want them. We refer to it as all of the above investing, where you want to have some large companies, medium-sized companies, and smaller companies in your portfolio, a nice blend. And I find this chart kind of interesting. It shows basically the last 10 years since June 2011, and to date stamp this a little bit, you're basically talking about that moment in time where you see that blue graphic, which has dominated the last 10 years. Well, that one did not dominate the 10 years before that. Remember the last decade when returns were actually negative for that blue bar? And the S&P 400, which represents the medium-sized companies, actually still behaved pretty well. And this one is kind of upside down because normally the S&P small companies do pretty well. And of course, they all add up to that value line arithmetic average, which is an all of the above measure. But what we're showing you here is that for the last 10 years, even though the last year has been a bit spectacular for some of those smaller companies, they're still lagging as they have for the last 3 or 4 years. And there just has to be some opportunity amongst those smaller companies. And that's part of what we'll be talking about. Here's another look at why we believe that. And Ken, I don't think we've ever looked at this before, so you and I are seeing this together for the first time. What I did is I took the stocks that are in the Value Line investment survey, the standard edition, and I divided them up into 4 quintiles. So the ones that had the lowest growth rates, the lowest quintile, the lowest 25% of all companies, that's what's showing up over here. So again, they've had a pretty good run. After the last decade, they've had this really good run. And maybe it's time to turn down the shopping efforts there a little bit. You always want to be seeking opportunities in all the areas, but maybe the emphasis needs to be over here. And that's been our feeling for the last couple of years. And there is still opportunity there, in our opinion. So we'll cover that in greater detail, but just thought everybody would kind of like to see that. And notice that once again, these numbers are a little bit depressed compared to historical levels. Any thoughts, Ken?
Well, I've been thinking, Mark, for a couple of months that the nature of the small company, in my estimation, has changed a little bit over the last 20 years. I can't remember a lot of companies coming to the market as IPOs or anything else that weren't making money. When a company was ready to come to a public market, it was also ready to start making a profit. And today it seems that an awful lot of small companies that come to market with no thought of earnings and no potential to have earnings for the next 2, 3, 4, 5 years. And so I'm just wondering if a little bit of the nature of the small company has changed when we suddenly toss into the group these companies that have come at the urging of venture capitalists or however else they've made their way to the public market, but they are existing on the largesse of other people to keep them afloat, while they work feverishly to try to turn a profit. That's, to me at least, that seems a little bit new. How do you feel about that?
Yeah, you're basically talking about, some of the early stage investing stuff. I would take it a step further and say there's been a number of companies that come public without earnings that are suddenly mega caps. And I think we're seeing more of that in the last 20 years than we probably have historically. You used to have to be an IBM or something like an IBM to be one of those big companies. And now you can put, I don't even know how to put it, one of these internet companies from 20 years ago, or some of the current stuff. Look at Coinbase coming public with a market capitalization of $85 billion. So they're out there too. So yeah, some interesting stuff. Here's another.
Well, it plays right into this chart that you're putting up here right now, because we're just not seeing the growth, even if it's only sales. In a lot of cases, we're not seeing the growth come anywhere near matching what the capitalization of the company is, what the stock price tends to be. And I don't know what other measurement you want to use, but many of these companies don't have an earnings, so you can't use price to earnings. They don't have cash flow, so you can't use cash flow as a barometer. There's many of the things they don't have yet in place. So what barometer do you use to measure the value going forward? And I'm dismayed. I'm not going to say that the link between valuation and what a company does is broken, but I certainly think that it's been stretched in the last 3 or 4 years, and stretched to the point where it becomes more and more and more difficult for us to determine what kind of growth is inherent in the company we're trying to study.
Yeah, I mean, that is a topic all by itself that we can probably dig into. I see it as kind of a leverage symptom, and I'm thinking about a different kind of leverage. You're basically talking about also a life cycle type of leverage. We do overcome some of that with the projected return on value. We overcome a little bit of it, but I'm hearing you. That's an important factor. What you're looking at here, everybody, is we cover about 600 funds at Manifest, and we are still retooling that area. Hopefully we'll have that done here fairly soon. You are looking at the only 27 that have a relative return, in other words, beating the market by 5 percentage points or more. So you're looking at some people who know what they're doing. Out of the 600 funds, most of those 600 are equity funds. So at the very top is Kathy Wood and ARK Innovation. That's the one that I bought this morning, ARKK. And you can see that they're actually up 31% over the last 7 years, beating the market by 17%. So we do spend some time looking at that. But the purpose of this chart in the middle of a small company presentation is to draw the attention to success and excellence in investing, and this common theme, common denominator, common thread of sales growth forecast that's circled on there from top to bottom. In order to achieve the type of numbers on the right-hand side of the page, it's my opinion, I'm pretty sure it's Ken's opinion, that you'd have to have a blend of small, medium, and large companies to do that. And some of these are obviously very assertive / aggressive, but the common denominator on this chart, well, there's two common denominators: success and excellence in combination with a fairly or relatively high level of growth for the companies that they own. So kind of a fascinating chart, and we regard this as some people who seem to know what they're doing, and we're going to mine them for ideas. Any other thoughts on that, Ken?
A couple of questions, Mark. The red entries, any significance to the color?
They're either closed or have a commission, a brokerage commission known as a load.
Okay, and the yellow highlighting, any significance to it?
Well, that's your fault. Remember what you asked me to do?
We lost communication then. I was looking for narrowly, well, maybe you did it. Are these pretty narrow?
I do listen to you.
Okay, are these pretty narrow in their in what they're putting out there? They're not broadly based as far as type of company. Well, I guess maybe this is exactly what I asked for.
There's
Okay.
sector or industry funds that are, focused on any one area. And
Okay.
yeah, it can be the type of thing that you use more as a, and I'm doing air quotes again, timing mechanism, or an opportunity. One example that I've always used is, I can remember years ago, I couldn't figure out what bank I wanted to buy, and a whole bunch of them were attractive. So I bought a bank sector fund, rather than try to identify a handful of banks. Did the same thing with utilities back about 30 years ago. So, that type of thing where you can invest in a sector. And a number of family members have had huge pieces of VGT. That's the Vanguard technology over the years. And they all think I'm a genius for recommending that one years ago. So yeah, that's what the highlighted ones are. They're kind of down one alley. The one that I do like to point out, because it gives most of us the heebie-jeebies, is the retailers that are shown there. Two of those top 9 funds are very retail dominated, and a lot of us have trouble with apparel retail or restaurants in our investing efforts. And statistically, the consumer discretionary stocks have been the most rewarding to shareholders over the last many years. So it's an area that's kind of interesting to explore and at least be aware of.
Just one last question, Mark. On the tickers themselves, what's the M colon stand for in front of many of the tickers?
Traditional mutual fund. That's just how Y-Charts knows where to look.
Okay.
That's telling Y-Charts how to look it up.
So those without an M are definitely ETFs then, right?
That's correct.
Okay.
All right. So that's some of the stuff we'll talk about. One of the other things that we're going to talk about is this notion of taking a theme and nailing it down and drilling or funneling into it until we find a specific investment that is the best of the breed, or a leader within its sub-industry or industry, perhaps in some cases sector. But these are the types of themes that Ken and I are going to go drilling into during the session on, is it Thursday, Ken?
Yes.
I gotta ask, is anybody gonna do any deep dive into looking at online gaming?
I probably
I
should
don't
have put
see
that on
anything
there.
there.
I must have a natural aversion to it, Kim. Unless it definitely falls into the travel and leisure type category a little bit, but not close enough for that.
And to be honest, Kim, Mark obviously came up with something that was kind of visually interesting as well as just a list, but I came up with a list of ideas, themes that you could kind of look at, and I had 70 or 80 things on that list, and it not only included online gaming, but it included esports. I see those things as complementary, but kind of different at the same time. So yeah, I think there's lots of ideas that aren't on this graphic right here, but you have what we're talking about. It's this coming up with a theme is fairly simple. Now coming up with stocks to back that theme up, that's where it becomes more difficult. And the broader your theme, the more difficult it is to tie it to some stocks that you might be interested in. One of the broadest themes on this whole page is right smack dab in the middle, this idea of infrastructure. Every club that I'm visiting right now wants to know how to make money off of infrastructure. And that's just, that's like trying to write a 10-page term paper on U.S. history. It's not going to be done. And if you can't narrow the field from that one word infrastructure, if you can't narrow down to some more specific ideas, then I think you're doomed in trying to find a good stock.
Well, I guess that I just know that when I presented Round Hill Investments, and they have nothing but thematic ETF indexes, that's a great place, because I think, Mark, isn't that where you found Tennyson?
Yeah, Tencent would be related in that. And I am finding we're going to talk about Kathy Wood and ARC investments also as part of this. And one of her key areas is precisely that, Kim. We'll see with some of the companies that she's chosen for her funds that are smack dab in the middle of that. In fact, some of them exhibit some of the characteristics that Ken was talking about a few minutes ago, being pretty quick to market, but a lot of potential, just a lot of potential.
Right. Well, that's kind of like Planetar.
Yep, they're on the list too. All right.
Okay.
So going back to a moment in time, you've heard us talk about it, and I just wanted to reinforce it because I was riding in the car with my son-in-law this weekend and talking about Dogecoin and Ethereum, and he's actually a world-class expert on that whole area, so I'm going to pretend that I understood half of what he was talking about. And but one of the things he kept coming back to was this notion of, all these people sitting around, from your in-laws to your hairstylist, talking about Dogecoin and Ethereum and all the cryptocurrencies and tossing around these massive return numbers. And what he kept coming back to was, back about a little over a year or so ago, we were kicking around a few names like, in our case, Wolverine Worldwide. We'll show you in a second here. But a number of household names of real companies that you could invest in. And back in late March last year, we talk a lot about this relative strength index. When it gets below 30, it's an indication of a company being potentially on sale. Well, when it gets down under 20 or under 10, that's really quite a moment where it's probably been absolutely destroyed by the institutional investing community. We call them rhinos, and they can be tremendous opportunities. So this is what the list looked like. You can actually go back to the forum and take a look at it. Some of those companies on there are very familiar to some of us. And just wanted to go back and point out that we actually bought some of these. And in fact, Ken, would Boot Barn be the successor company, the one you were talking about earlier in the green room?
I don't think so, Mark.
No,
The one that I was talking about is the company that owns Designer Warehouse, DSW.
And now it's Designer Brands or something like that?
I don't remember the name of the company. Somebody in our audience probably can help me out.
I was trying to remember if Boot Barn actually picked up the Discount Shoe Warehouse. But anyhow, they're up four times, a 400% return. And Wolverine and Gildan, Sportwear, Meredith, the publishing company, actually took stakes in a number of these. I've actually sold the Wolverine Worldwide that I bought back then. I think I actually posted on the forum when I bought it and when I sold it. But I bought 6 or 7 of these and I just noticed the returns. You know, pretty spectacular. So again, if we get that type of an opportunity, and this afternoon the market seems to be working on providing us some of those opportunities, just be mindful that when these things get really punished and you find a company that you can sink your teeth into, it can be quite rewarding. And a lot of times you don't have a lot of time to react to some of these opportunities on the deep discounted moment in time type of thing. Any other thoughts, Ken?
No, I agree 100% that the time to be buying is, when everybody else is deciding to convert to cash, and maybe something's happening right now that'll make some of these extremely expensive stocks a little bit more palatable. But you just have to work a little bit harder to find candidates right now. They're out there, and we're going to look back in 12 months and we're going to wonder why we didn't see them all. Maybe we'll give you some ideas about a few of them at that panel discussion this coming Friday.
All right, here's your reminder that all of these sessions are recorded, including the roundtables and all of the educational sessions that we do, including the ones over the next few days, on YouTube under Manifest Investing. You can subscribe if you want to be reminded anytime we bring new content there. Please, if you like something, hit the like button. And here's a reminder that if you want to go back and do some warm-up for the sessions, if you want to go back and look at the wonderful decisions I made back during this session and compare how not wonderful they were to the one a few months later, you can actually go back and do some advanced homework. And with that, we will leave everybody. We'll stick around for some Q&A, I think, here for a few minutes. But Kim, that's your, I believe that's your vantage from Key West right there. Does that look familiar?
It was beautiful.
So did you get recharged? And
I did. I recharged my battery, met up with some friends, had some good conversation. Might have had a little drink or two.
yeah,
And I got to go to the first concert, a live concert.
Now, in the audience poll last weekend, we decided that was probably a pina colada that you had. Send us a picture of.
Yes, it was.
The drink of
It
choice.
was.
Huh? All right. Any other thoughts, Ken?
Nope. I'm ready to finish up getting things polished up for the conference, and I'm willing. A couple of you asked to see some of that, what I was going to talk about Regeneron, so I will talk about it real quickly here.
Okay, I'm going to go ahead and shut down the recording for now. We can put whatever we cover here in the forum, but thanks everybody, and we look forward to seeing you during the successful investing sessions. Take care, everybody. Good hunting out there.